How's everybody doing tonight? Welcome to the Strategy Room. I am your host, Dr. Joe Berquist. You are with the banker next door on this Saturday night, March 8th, 2025. It's so great to be with everybody tonight. As usual, I have a jam-packed show with a ton of stuff to go over. It's unbelievable how much breaking news is just coming in every week. At this point, over the last couple of months here, it's been just kind of a wild ride. And so there's just a ton of great information and stuff to get into here tonight. So let's pull this in. And you know what? We're going to start off, as I have been for the last month or so here, looking at the Doge clock, seeing what are we doing here. So this is the U.S. debt clock, as it were, website. And we can see up here in the upper left-hand corner. So Doge is now saying that they have saved U.S. taxpayers $178 billion. But what is interesting here is they've now added an additional feature here, which is right next to it. So you have the Doge clock, but then it also has a little category right next to it that says savings per taxpayer. And I love that. So basically, we're up to $1,590 saved per taxpayer. So not too bad. It's a little start to get off with here. Definitely want to be doing a little bit better there in that category, that's for sure. But that's a good thing, going in a good direction there. So I just wanted to point that out to everybody that we had this new little feature here showing the savings per taxpayer. So I thought that was pretty cool. So, and I'll tell you what, we'll come back to this in a little while, but let's kick off. I want to kick off tonight with a couple of stories. So the first one here that I saw this week was Scott Bessent, who's the new Treasury Secretary. So Scott basically said that he was slightly shocked by the scale of fraud that was uncovered by Doge. So as Doge pushes to cut spending, Treasury Secretary Scott Bessent says he's somewhat shocked by the amount of fraud it has already uncovered. So Treasury Secretary Scott Bessent said Friday that the Department of Government Efficiency, DOGE, is making significant strides in cutting federal spending, adding that he is slightly shocked by the extent of fraud uncovered, not just waste and abuse. Speaking in a February 29th interview on Bloomberg podcast, Bessent was asked whether DOGE cost-cutting measures would have a material impact on deficit reduction. I think we can make a pretty big hit here, he replied, explaining that if DOGE identifies $300 billion in savings, which he suggests is possible, it could reduce the annual deficit by approximately 1 percentage point to a share of gross domestic product, otherwise GDP. Even if the savings total only $150 billion, he says this is still moving us back toward the target, and we're determined to get this down. So Bessent emphasized that DOGE, which was tasked by President Donald Trump with rooting out waste, fraud, and abuse in federal spending, has already uncovered substantial efficiencies and a surprising amount of outright fraud. When it comes to waste, fraud, and abuse, I think most of us think in terms of waste and abuse, Bessent said. I've got to tell you that I'm slightly shocked at some of the fraud we're finding, and you're going to be hearing about more of that over the next couple of weeks. As the ultimate savings that DOGE will deliver, Bessent said, we'll see. So I think that when Scott makes these comments here, I think that he's obviously the head of the Treasury. He's been there working now for a couple of weeks, seeing what's going on inside the Treasury, and he no doubt has access to information and things that none of us have. And so I think that when he says there that, you're going to be hearing about more of that over the next couple of weeks, I think he already knows that there are things that are there that have been found that are going to come out. And so I just think that this article was somewhat telling about, kind of telegraphing in a way, like some of the things that are going to be coming out here and probably in the months to come, not just in the next couple of weeks, but probably over the next, 3-4 months. I'm sure they're going to be coming out with all kinds of stuff. However, I would make one comment on this where he says here that, DOGE is hoping to, if they can identify $300 billion in savings, they're not there to save $300 billion. They're there to cut $2 trillion and get us back to a balanced budget. If the best that they can, I'm just being honest here. If the best that they could do is save $300 billion, then it was a waste of everyone's time, because that doesn't even, it could reduce the annual deficit by 1%. Like, Really? Let's go back and take a look at this. We are currently running a $2 trillion annual deficit. That means every year we're spending $2 trillion more than what the government takes in. And that is going right on the top line number. It's going right to the national debt of $36 trillion plus. Now, we can't keep doing this. We just can't keep doing this. It's not sustainable. We have to cut the spending. And if all Doge is going to do is come in and cut $300 billion with that, I mean, that's just a waste of time. I mean, the government could cut $300 billion by accident. And again, and I'm just being honest with that. That's just the truth. They could cut $300 billion, tripping over the steps, walking into the Capitol building. We need serious cuts here. So, but anyway, all right, but let's take a look at a couple other things here. So Treasury Secretary Bessent says economy could be starting to roll a little bit. Treasury Secretary Scott Bessent on Friday acknowledged some signs of weakness in the U.S. economy. Could we be seeing that this economy that we inherited is starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending, Bessent said on CNBC Squawk Box. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period, he said. Describing the economy as inherited is a reference to the administration under then President Joe Biden. Current President Donald Trump took office on January 20th. Under Biden, the U.S. saw generally strong economic growth. However, there were signs of a slowdown in late 2024, and inflation remained above the Federal Reserve's 2% target. You got to love CNBC. They're always, I love these guys, but they're always a day late and a dollar short. Generally strong economic growth. As Dr. Evil said, right, Scotty, right. In the first few months, the Trump administration has taken steps to reshape global trade policies and to reduce the federal workforce. There has not been much hard economic data reflecting Trump's term, though consumer surveys have shown a decline in confidence. All right, we'll get to the jobs numbers here in just a minute, but so I think there are a couple of things here with this, and this is the reason why I wanted to put it out. So I think he's being a little overly optimistic right this second. I do think that things are going to get worse before they get better. I think that 2025 was always going to be a kind of a bumpy year with a lot of kind of fits and starts, if you will, ups and downs, peaks and valleys. This is going to be a very interesting year. And I think this is the most critical comment, though. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. Yes, absolutely. There it is. So if you are going to reduce the spending and you're going to go from a government focused economy to a private sector business focused economy, you're going to have, there's going to be some major swings, if you will, in that process. And you're going to have a few rough days. That is not going to be a simple task of just, it's not like you can't just flip a switch or press a button. That's something that could take, honestly, it could take years to make that happen. And, but if that's really what they're going to do, then I think that's a great thing. And that's exactly what we should be striving for. So I like the plan, but I think it might be just a little bit over optimistic at the moment as to where we're ultimately heading here. So, okay. Let's go on to some other big news here. I want to get to this big news on beneficial ownership information here. Then we're going to talk about the jobs reports. We're going to talk about mortgage rates. And then we're going to get into, manufacturing. We're going to look at the beige book for a second. And then we're going to talk a little bit about what is the Fed going to do now? What's the Fed, doing at the moment here? So this was major news this week. And this just, this made me happy. I had a happy moment for a couple minutes here, because I was just so happy to see this. Treasury Department suspends enforcement of ownership information reporting for millions of businesses. So this is beneficial ownership information, which I don't think crusading is a strong enough word. I have been crusading against this whole BOI nonsense. The U.S. Department of the Treasury on Sunday said it would enforce the penalty. Would not enforce the penalties or fines associated with the beneficial ownership information or BOI reporting requirements. Previously, the Treasury set a March 21st deadline for businesses to comply or risk fines of up to $10,000 or 2 years in jail. You believe that one? 2 years in jail for this. The Treasury will also propose regulation to apply the BOI rule only to foreign companies. Love it. So the U.S. Department of the Treasury on Sunday announced it won't enforce the penalties or fines associated with the beneficial ownership information or BOI reporting requirements for millions of domestic businesses. Enacted via the Corporate Transparency Act in 2021 to fight illicit finance and shell company formation and to also collect as much data as possible on small business owners. BOI reporting requires small businesses to identify who directly or indirectly owns or controls the company to the Treasury's Financial Crimes Enforcement Network, known as FinCEN. The act became effective near the end of the first Trump administration, despite a veto by the president. After previous court delays, the Treasury in late February set a March 21st deadline to comply or risk civil penalties of up to $591 a day, adjusted for inflation, or criminal fines of up to $10,000 and up to 2 years in prison. That's incredible, man. So for not filling out this stupid form to go in this database, if you didn't do this, they were going to put you in jail for 2 years. Think about how insane that is. The reporting requirements could apply to roughly 32.6 million businesses, according to federal estimates. The rules were enacted to make it harder for bad actors to hide or benefit from their ill-gotten gains through shell companies or other opaque ownership structures, according to FinCEN. In addition to not enforcing BOI penalties and fines, the Treasury said it would issue a proposed regulation to apply the rule to foreign reporting companies only. President Donald Trump praised the news in a Truth Social post on Sunday night, describing the reporting rule as outrageous and invasive and an absolute disaster for small businesses. Other experts say the Treasury's decision could have ramifications for national security. This decision threatens to make the United States a magnet for foreign criminals, from drug cartels to fraudsters to terrorist organizations. Scott Graytech, director of advocacy for anti-corruption organization Transparency International USA, that's a mouthful, said in a statement. The reason why Scott has those comments is because he's probably making money off this somehow. So he's probably just mad that his gravy train just came to an end. So, but no, the BOI, this whole thing was ridiculous. First of all, you want to talk about going after illicit financial activities and companies that are doing fraudulent things. That's fine. There's no problem. I hate to break it to you. We already have a system for doing that. We already have laws for doing that. It's called, if you think somebody's doing shady, you investigate them. You open an investigation. You impanel a grand jury. You charge them with crimes like that. That's a whole process that we have in place. This is overkill. This is not needed at all. If I want to start a company, I live in the lovely state of Pennsylvania. So if I want to start a company, I have to go to a lawyer and I have to fill out some information. And then I have to file forms with the state and I have to form the company. And then when I form the company, I have to put an ad in the local paper informing people that I have started this business in case anyone may, wait for it, have any legal claims against me or the business. Okay, so you have to do all that. You have to register with the state. The state immediately sends you tax forms. Okay, so in case you're going to hire any employees, that you're paying all the state taxes. So everything is registered. And then after I start the business, if it's a good business and it's going well, I start to make a little bit of money. You are now filing tax returns every year on that business. You have to open bank accounts. If I go to open a bank account, what do I have to do? I have to provide them with all of the documents on the corporation. So say it's an LLC. When I come in with an LLC, what do I have to bring? I got to bring an operating agreement. I got to bring a certificate of formation. I got to bring the EIN number that I get, wait for it, registered from the IRS, that the IRS sends you. You need a tax ID number to file a tax return. So, you do all this already. This is stuff that's already done. You're already registered with the government. If the government needs to find me or any other small business owner out there, we're really easy to find. You pick up the phone and you call us. It's not that hard. So this whole thing was just amazing government overreach here. And again, it gets bad. And again, I don't mean to be on kind of this whole rant about this whole thing, but it just gets on this thing that I've talked about for years about the government having this insatiable appetite for never ending amount of data, just wanting to know what you're doing every 5 minutes of the day. And some of this stuff needs to be reined in a little bit. It needs to be pulled back. And this is a great start. I'm so very happy to see this. I think this is a huge win for 36 million plus small business owners across the United States, and it's a wonderful thing. So, okay, now let's get into the jobs numbers for a few minutes here. I got a couple articles here related to jobs that we're going to take a look at here. So U.S. payroll growth totals 151,000 in February, less than expected. So non-farm payrolls increased by a seasonally adjusted 151,000 on the month, better than the downwardly revised 125,000 in January, but less than the 170,000 consensus forecast. Federal government employment declined by 10,000 in February, though government payrolls overall rose by 11,000. Average hourly earnings climbed 0.3% as expected, though the annual increase of 4% was a bit softer than the 4.2% forecast. So job growth was weaker than expected in February, though still stable despite President Trump's efforts to slash the federal workforce. Again, like we said, non-farm payrolls increased by 151,000 jobs. And then we have a nice little chart here. And we could see here, though, that basically the labor market, especially in the fourth quarter of last year, primarily most of last year, was really weakening. I mean, in April, 108,000 jobs. May, bump back up a little bit to 216. June, 118, 144 in July, 78 in August, very weak. And then for some reason in September, we had this giant backup to 255,000. Could it be that, we had an election that was coming right around the corner? I don't know. And then we plunge right back down to 43,000 jobs in October. Funny how that works. And then in November, we're magically back up to 261,000 in November. It's a miracle. And then Christmas, 321,000. And then in January, we dropped down to 125, and now we've had 151 for February. So anybody who has followed this show, has followed the podcast here over the last, year, at least the last year, if not longer. I have delved into the jobs reports on many of these months, many of these quarters, and we've looked at it. And the bottom line is that the job market is just nowhere near as healthy as the headline numbers have suggested definitely over the last year, perhaps over the last 2 years. There is a lot of underlying issues in the labor market. And what I find interesting, and I've said this, is that I've been very interested to see, now that we have a new president, a new administration, are we going to start to see the real numbers? Are the real numbers going to begin being presented? And I think that is part of what's going on here. I think the reason why these first 2 months of the year have been weak to get out of the gate is because you're actually just beginning to see the real numbers. And I am just curious. I wonder if this is a pattern that we're going to see, because it's going to take probably the rest of this year. Like, in other words, we're going to look at an article here in a second where we're going to talk about the reduction in federal payrolls. So you're going to continue to see this reduction in federal payrolls throughout the rest of the year. And that's going to take away from some of the labor force here. And then it's going to be on businesses to basically pick up the slack. And, will we start to see businesses hire? Can Congress do enough with tax cuts? How are the tariffs going to affect all of this? Potential war, other things going on. There's a lot of factors out there right now, and we're going to have to see. But again, my theory of the case, if you will, right now is that the labor market is going to remain very weak throughout probably the rest of this year. And we're going to continue to see some weak numbers here, I believe, especially if we start to see the real economic data, and we start to see the real things underpinning the job and labor force kind of come to the surface, if you will. So, All right, let's take a look at a couple other things here. So here's where the jobs are for February 2025 in one chart. So healthcare saw another strong month, leading the pack in employment growth among different groups across the economy. Government posted gains as well overall, though positions at the federal level saw a reduction in the period. So February marked another strong month for healthcare, despite job growth overall coming in weaker than expected, but stable. Last month, healthcare and social assistance led the way for job creation, adding 63,100 jobs, according to the latest data from the Bureau of Labor Statistics. That marked the fifth straight month that the category saw the largest gains. When including private education in the group, like some economists do, that figure grows to 73,000 jobs. So what are we looking at here in our chart? We got healthcare and social assistance were 63,000 jobs. Financial activities, 21,000. Construction, 19,000. Transportation and warehousing, about 18,000. Government, 11,000. Manufacturing, 10,000. Wholesale trade at 8.8 thousand. Mining and logging, 5,000. Information, 5,000. Utilities is 1.3. But then professional and business services, minus 2,000 jobs. Retail trade, minus 6.3 thousand jobs. And then leisure and hospitality cut 16,000 jobs. Now, let me ask this. Why might leisure and hospitality be down 16,000 jobs through the first month or two of the year here? Well, a lot of that hiring, it's seasonality, and a lot of that hiring takes place during the fourth quarter. And then you start to see in the first quarter of the year, you usually start to see a lot of those people getting laid off. And then they begin to bring them back kind of second, third quarter, and then make the big push in the fourth quarter. So that is probably some of the rationale for why you're seeing the leisure and hospitality have the reduction it has here. So although this is another strong performance for healthcare, Julie Pollock of ZipRecruiter noted that this level of gains has basically been happening over the last couple of years. Part of it is catch-up growth during the pandemic, when many hospitals' profit margins were negative because of the cancellation of elective procedures. The firm's chief economist said in an interview with CNBC, they did not do the hiring that they would have otherwise done, and now they're back to normal and hiring pretty rapidly. Evolving demographic trends are another factor at play, Pollock said. Evolving demographic trends. You mean the 25 million illegals that they let pour over for 4 years? That evolving demographic trend? She pointed out that the so-called peak 65 zone, a multi-year period where more Americans were set to turn 65 than ever before, is underway. Some of it is catch-up, and some of it's just the sort of huge demographic shifts that we're undergoing. Okay. Financial activities and construction were next in line in terms of job growth. Again, those two categories saw 21,000 and 19,000 positions added respectively. Government also saw growth of 11,000 positions during the month. That said, the BLS revealed that within the sector, federal jobs declined by 10,000. That comes amid efforts by President Donald Trump and the so-called Department of Government Efficiency, the DOGE, to act spending and workforce levels. All right, so we got that. Now let's take a look at here. So layoff announcements soar to the highest since 2020 as DOGE slashes federal staff. So U.S. employers announced 172,017 layoffs for February, up 245% from January, and the highest monthly count since July of 2020, Challenger, Gray, and Christmas reported. More than 1/3 of the total came from billionaire entrepreneur Elon Musk's effort to reduce the federal headcount. Challenger put the total of announced federal job cuts at 62,242. So President Donald Trump's efforts to pare down the federal government workforce left a mark on the labor market in February, with announced job cuts at their highest level in nearly 5 years. Outplacement firm Challenger, Gray & Christmas reported Thursday. The firm reported that U.S. employers announced 172,000 layoffs for the month, up 245% from January, and the highest monthly count since January of 2020 during the heightened uncertainty from the COVID pandemic. In addition, It marked the highest total for the month of February since 2009 during the global financial crisis. More than 1/3 of the total came from billionaire entrepreneur Elon Musk's efforts with Trump's blessing to reduce the federal headcount. Challenger put the total of announced federal job cuts at 62,000, spanning 17 agencies. With the impact of the Department of Government Efficiency DOGE actions, as well as canceled government contracts, fear of trade wars, and bankruptcies, job cuts soared in February. January's planned reductions brought the total through the first 2 months of the year to 221,812, also the highest for the period since 2009 and up 33% from the same time in 2024. The report comes amid heightened concern about the state of the labor market and the economy in general, as Trump's plans for tariffs, slashing the size of the government, and mass deportations and stringent immigration restrictions take shape. There has been a slew of mixed indicators about where things are heading, with consumer surveys showing concern over inflation and layoffs, while other data shows economic strength continuing. So, couple of things to say here on this. So, first of all, I would say some of this is a little misleading because of a couple of factors. Number one, part of this is they offered a package to basically employees who were on the verge of retirement. Like, in other words, people who were planning on retiring in the next year or two. They put out a sweetheart deal to them. It basically said, hey, listen, we will pay you your normal salary until September, and we'll give you a severance and some other perks if you basically take our buyout offer, if you will, to basically leave now and go retire early. So that's a part of what's happening here. The other thing is they're basically picking what they're calling the low-hanging fruit, and that is basically anybody who was basically anybody who was kind of on warning, anybody who was basically that weren't performing well, that were on warning, were in danger of losing their job, maybe hadn't shown up for work, that kind of stuff. They picked the people who were the easiest or the quickest people to fire right off the bat. If think about it from a corporate perspective, okay, you walk into an employer and you're now the CEO, and things aren't going well. You're losing money. You're losing $2 trillion a year, and you sit there and you go, okay, we gotta trim some things here. We gotta cut the fat, so to speak. We gotta cut back on some of these expenses. And what's the number one expense that any employer has? It's your payroll. Your payroll is always your number one expense. So that's the first thing everybody goes to, and they say, okay, who can we cut first? Okay, well, let's look at the bottom 10% first. Let's look at the people who are underperforming. The people who are on warning, aren't doing a good job, have been disciplined, people that have maybe just, people that are chronically late, people just not putting forth the effort. Okay, we're going to cut them first. And we're going to do that because we're going to send a message to everybody else in the company that, hey, you better produce, you better start doing your job to the best of your ability. Otherwise, you're not going to be around here for very long. So that's in a very real way, that's what's happening here. The president is approaching this from a corporate mindset, from a corporate point of view, and basically saying like, hey, we're running these giant annual deficits. We've got to do something here. We have to cut. And here's another perspective. The government has over 2 million employees, and I would be willing to bet that the government could cut 500,000 employees and nobody would notice. I'd be dead serious about that. I think they could cut, no sweat, 500,000 of those employees and nobody would notice. And we're going to see how this plays out, because this, on the other hand, this is just the beginning. There is no doubt that they want to cut anywhere from probably 10 to 20% of those 2 million plus. I think the government probably has 2.2 million employees. So there's no doubt that they want to cut a significant number of government employees. They want to cut probably 400,000 of those employees, and then see where they're at that point. So that's where I think this is going. So again, this is not going to slow down. This is going to continue to be the norm, I would imagine, for at least the next 6, 7, 8 months, as they continue to get things, under control and get things going. So, okay. Here's another article. Just announced layoffs surged 245% in February amid Doge-related federal cuts. Federal workers account for more than 1/3 of last month's tally. So planned job cuts have hit this highest level since the pandemic. We got that already. I know there was something in here that was interesting that I wanted to point out. It appears the administration wants to cut even more workers, but in order to fire the roughly 200,000 probationary employees, like I just said, was blocked by a federal judge. It remains to be seen how many more workers will lose their federal government roles, according to Challenger and Gray. When the mass layoffs occur, it often leaves remaining staff feeling uneasy and uncertain. Yes, just the message that I just said that they were going to send out. The likelihood that many more workers leave voluntarily is high. According to Challenger data, retail and technology led the way in the private sector. Retailers announced 38,965 job cuts, bringing the year-to-date total to 45,375. This is a 572% jump from the first 2 months of 2024. So let's see here. Playing Dodgeball in the labor market. So the report comes amid mounting concerns about the state of the labor market and the broader economy's health. So far, in the early days of the Trump administration, there have been mixed indicators signaling where the economy could be heading. Yes, and I think, and like I said, I continue that sentiment. I believe that we will continue to see mixed indicators, if you will, and we're going to be seeing this for, I think, the most part of the year. I don't think this is going to just magically end in a month or so. So, okay. So what effect is some of this stuff happening right now on the mortgage market? What's going on with mortgage interest rates? Well, we have here weekly mortgage demand surges 20% higher after interest rates drop to the lowest since last year. So the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, which is $806,500 or less, decreased to 6.73% from 6.88%. Total mortgage application volume jumped 20.4% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. This was not only the first increase in 3 weeks, but it is an outsized weekly move. A sharp drop in mortgage interest rates finally lit a fire under loan demand. Both current homeowners and potential home buyers jumped back into the market after a lackluster showing for this year so far. Total mortgage application volume jumped 20.4% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. This was not only the first increase in 3 weeks, but it is an outsized weekly move. Mortgage rates were clearly the culprit. The average contract interest rate for 30-year fixed-rate mortgages decreased to 6.73% from 6.88%, with points falling to 0.6 from 0.61, including the origination fees for loans with a 20% down payment. That is the lowest level since December of 2024. Mortgage rates declined last week on souring consumer sentiment regarding the economy and increasing uncertainty over the impact of new tariffs levied on imported goods into the U.S., said Joel Kahn, an MBA economist, in a release. That's not an MBA like he's got at MBA. That's the Mortgage Bankers Association. Those factors resulted in the largest weekly decline in the 30-year fixed rate since November of 2024. Applications to refinance a home loan, which are the most sensitive to weekly moves in interest rates, jumped 37% for the week and were 83% higher than the same week 1 year ago. While the vast majority of borrowers today still have loans with rates well below what it is being offered today, more recent buyers from the last 2 years are now able to benefit from a refinance. Applications for a mortgage to purchase a home rose 9% for the week, but were still just 2% higher than the same week 1 year ago. This is a period where we typically see purchase activity ramp up, and purchase applications were up over the week and continued to run ahead of last year's pace. More green shoots as we head into the spring home buying season. Okay, let's go to the next thing here. So mortgage demand jumps as rates fall on tariff uncertainty. So mortgage demand for purchases was up 12% and refinancing rose 37% from last week as mortgage rates dropped. Again, the mortgage rate dropped to 6.73%. Rates were dropping amid economic uncertainty related to tariffs. So we got that, and then, but there was another one. So here we go. So this is interesting. So mortgage rates fall for a ninth straight day, sinking to the lowest level since October. So, and then this has a kind of a nice little chart here on it, so we could just kind of track. So here we were back in December, and we were basically at 6.53%. We jumped in mid-January. We got all the way up to over 7% at 7.13. February 12th, we were at 6.93, so it came down a little bit. And now we're tracking back down toward that 6.5% rate. So which is good, We're heading back into a good territory again. So just wanted to point that out. So some good news here on the front as mortgage rates continue to come down here a little bit. So now, what is happening here in manufacturing? So manufacturing growth slows in February as customers wait and see on tariffs. So the Institute of Supply Management's Manufacturing Purchasers Managers Index PMI survey showed that the factory sector expanded in February, the second straight month of expansion after 26 straight months of contraction. However, the February reading was down from the month before and came in below economists' expectations. The prices paid index increased by 7.5 percentage points as tariff uncertainty also caused new orders to fall. So after nearly 2 years of lackluster production, the U.S. factory sector efforts to mount a comeback slowed in February with a closely watched industry survey showing that tariff worries were making manufacturers nervous. The Institute of Supply Management's Manufacturing Purchasing Managers Index survey showed that the factory sector expanded in February with a 50.3% reading. It's the second month in a row the index has registered above 50, indicating an expanding manufacturing sector after 26 straight months of contraction. However, the February survey reading was down from the month before and came lower than the economists surveyed by the Wall Street Journal and Dow Jones Newswire expected. The report weighed on market sentiment Monday as investors have grown increasingly concerned about the health of the economy and the impact of policies pursued by the Trump administration. Tariffs spur concerns about inflation. Selected commentary. New orders plunged in contraction in February as tariffs uncertainty caused many downstream consumers to take a wait-and-see approach to expenses in 2025. The potential impact of the tariffs has already caused some real price increases for manufacturers as the prices paid index rose by 7.5 percentage points to hit 62.4% in February. Prices growth accelerated due to tariffs, causing new order placement backlogs, supplier delivery stoppages, and manufacturing inventory impacts. So we will have to keep an eye on this. Obviously, it's not like terrible news, but it's not great news. I mean, obviously, manufacturing had kind of been in the dumps for the last 2 years, but it got, like I said, it got back up over 50. When the survey gets up over a reading of 50, that's a good thing. So it got back up over 50. Came back down a little bit. Some of the economists and people that watch this were expecting it to be up a little bit higher, but again, not great news, but not dire news either. So we'll have to continue to keep an eye on that and see what happens. So let's take a look now. The Fed always releases what's called their beige book. So we got the beige book released this week, and what did it tell us here? So the beige book shows an economy on the brink of Trump's tariffs. So the Federal Reserve's beige book report showed growing uncertainty and anxiety among business leaders about the impact of President Donald Trump's escalating trade wars. People interviewed in the report said they would likely have to pass cost increases from tariffs on to customers. Overall, the economy is still growing, but a slowdown is becoming more likely, the report showed. So the Federal Reserve's beige book reported on the economy was shot through with the word uncertainty at similar terms as businesses braced for the impact of President Donald Trump's widening trade war. The report released Wednesday showed the economy overall was still growing slightly. Still, businesses and civic leaders were uncertain, nervous, and worried about the impact of Trump's policies, especially the tariffs against Canada, Mexico, and China he imposed Tuesday. Trump's plans for mass deportations of immigrants were another source of concern, as several business leaders said their employees were skipping work out of fear of deportation. But why should that be a concern? Because you're not hiring illegal workers, right? Because that's against the law, right? Anyway, the Beige Book was the latest in a series of reports and surveys to show growing anxiety about how tariffs and other Trump policies will affect the economy. Experts say the tariffs could push up the cost of living and slow the economy, and the uncertainty itself could discourage investment and hiring. Contracts in most districts expected potential tariffs on inputs would lead them to raise prices, with isolated reports of firms raising prices preemptively, the report said. In the Dallas district, manufacturers were especially nervous. Respondents said the back and forth tariff talk has been stressful and that the heightened uncertainty is highly disruptive, the report said. In Boston, prices increased moderately on average as wholesale food prices spiked, and contacts expressed concern that tariffs would contribute to more intense pricing pressures moving forward. In Philadelphia, employment continued to grow somewhat, although firms were more reluctant to hire amid economic uncertainty. Overall, the report painted a picture of an economy in a precarious position amid Trump's trade wars and his moves to rapidly cut federal employees and programs. Such changes have created considerable uncertainty for businesses and consumers and pushed up inflation expectations. Anthony Fonash, an economist at Moody's Analytics, wrote in a commentary, "Our baseline calls for slower but still solid growth in the coming months. Yet, the economy appears increasingly fragile, especially since asset markets with their frothy valuations seem quite vulnerable to a sizable correction." Yes, well, we shall see. So now we got the Beige Book here, and we got their interpretation here of the uncertain economy, right? So what does the Fed have to say about all this? So, all right, so Fed waiting for greater clarity on Trump actions before making rate decisions, says Jeremy Powell. We are focused on separating the signal from the noise as the outlook evolves, said the Fed chairman. Okay, so Federal Reserve Chairman Jeremy Powell did little to soothe market jitters over President Donald Trump's trade policy changes, vowing a wait-and-see approach. Powell said on March 7th that the U.S. Central Bank could afford to be patient and wait to determine the effects of the new administration's actions before cutting interest rates. As the White House moves forward with implementing significant policy changes to fiscal, immigration, regulations, and trade, the Fed will wait for greater clarity before crafting a response. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy, Powell said in a prepared speech for the U.S. Monetary Policy Forum, adding that policymakers are parsing through incoming information. We are focused on separating the signal from the noise as the outlook evolves, he added. We do not need to be in a hurry, and we are well positioned to wait for greater clarity. Policy is not a preset course. Powell alluded to the various projections anticipating inflationary effects from the president's tariffs. However, he cautioned that there remains plenty of uncertainty surrounding the specifics of Trump's levies, from what will be affected to how long they will be implemented. Still, Powell noted these tariffs are likely to affect the broader economy and impact importers, exporters, retailers, and to some extent the consumers. He recommended that economic observers examine what occurred in 2019 when the Fed navigated various developments in tax, regulatory, and trade policies. At the time, the U.S. Central Bank pulled the trigger on 3 interest rate cuts, defying market forecasts of policy tightening. It's really the effect of all these policies that matter for our policy, the Fed chair said. It's not simply what's happening with tariffs, it's what's happening with growth and all the other things as a result of these broad changes in economic policy. Powell's comments come after his colleagues, including Fed Governor Adrian Kugler, delivered end-of-week prepared remarks. Okay, so Powell is saying a lot of stuff there in this article. So basically, he's basically telling you, if you read between the lines, that basically they don't have any plans of cutting interest rates for the rest of this year. That's what he's telling you if you read in between the lines. But what he's also telling you there is he wants to pad. Like he's not prepared. He's not prepared to come out and basically say that, oh, what Trump is doing is going to wreck the economy. He's saying that he cautioned that there remains plenty of uncertainty surrounding the specifics of Trump's levies, from what will be affected to how long they will be implemented. In other words, what he's saying there is that he's saying, you know what? There's a chance here that Trump puts these tariffs on, and that these other countries basically back off real quick and come right back to the table and say, listen, we want to make a deal. Let's make a deal that's better for the U.S. and you back off on the tariffs. Okay. And then Trump goes, yeah, no problem. You give me the deal I'm looking for and I'll take the tariffs off. So he's saying that there's a real probability that is what's going to happen. So again, he's like I said, he's patting himself here. And then he also pointed out, rightly so, he recommended that the economic observers examine what occurred in 2019. In other words, you mean that magnificent booming economy that we got under Trump? Yes. When the Fed navigated various developments in tax, regulatory, and trade policy, you mean all the good stuff that had happened in 2016, 2017, 2018, and 2019. Yes. So, but he can't bring himself to say that, oh, you remember when we had that incredible economy there for a few years because of all the things that Trump had done. Yeah, he can't bring himself to say that. So he recommends that economic observers examine what occurred in 2019. Okay, so, but look, I think the big thing right now holding this up, the rate cuts, is the labor market is starting to swing to a not so great place, right? So the thing that's holding us up is basically the inflationary pressures. With inflation ticking back up, and Powell is really going to lean in on this narrative of the tariffs causing inflation. The tariffs are not going to cause inflation. Government spending is what causes inflation. Okay, that's the cause. The root cause of all inflation is government spending. Okay, if we want to get things under control, we have to cut this. Okay, this $2 trillion deficit. You get that under control, and you're going to get inflation under control. Inflation will back way down if you could get this spending under control. That's where that's where we're at there with that. But again, they have this whole narrative, and I'm going to be doing, just so everybody knows, like, I'm going to be doing an episode on tariffs. Basically, I want to talk about trade and tariffs. I think that will be an episode that I'll be putting out this week. It will be a little bit of a special episode because I want to point out what is really happening. Like, why, like, everybody talks about, oh, trade's going to, Trump's putting these tariffs on and it's so horrible and it's terrible and everything. But they don't talk about the why. They never dig into the numbers and talk about, well, why is he doing this? He's doing this because we have a major imbalance. And the United States, by putting these tariffs on, the U.S. has all the leverage over these countries. We have the leverage over Canada, over Mexico, over China. He's going to put these tariffs on. It's going to make them feel the pain, and then wait for it. They're going to come back to the table to make a deal. That's what's going to happen. And the more pain he puts on them, the better the deal he's going to get for us when they come back. Okay. That's the reality of what is going to happen. These countries could talk tough. They could say all they want. Trudeau can get up there and be like, oh, we're going to fight and we're going to do this, whatever. Yeah. Believe me, it's all going to end real quick. Okay. Because the numbers are on our side. You look at the trade deficit right now. You look at the trade imbalances that we have. This is all on our side and in our favor in the long run. That's not to say that we don't feel some short-term pain. That's not to say that we don't see a little bit of disruption in the economy because of these tariffs going on. It's not to say that. But in the long run, if you look out 6, 12 months, 24 months, these things are going to pay off for us in a big way. And like I said, I'm going to do an episode covering all that because I really want people to see the real numbers. I want people to look at, the trade. You got to look at trade, and you got to look at our massive trade deficit. When you look at all that, you then begin to understand why he's doing what he's doing with the tariffs. So, but like I said, I'm going to have an episode. I'm going to cover all that. And hopefully people will find that very informative. So, okay, where are we at here? All right, let's jump into a couple more announcements this week with a couple of things that came out. So this is basically CFPB tells staff not to resume supervisory work, stoppage affecting payouts. So The Consumer Financial Protection Bureau has instructed its staff not to resume supervisory work, even as it claims to be committed to meeting its legal obligations, Reuters reported on March 3rd. Cassandra Huggins, a top official in the CFPB's Division of Supervision, in an email reportedly said the Bureau's senior officials confirmed that supervisory work will not restart. That came a day after a separate internal message from Mark Paletta, the CFPB's chief legal officer, saying staff should perform legally required work, according to the report. So acting CFPB Director Russell Vaught in February reportedly closed the organization's headquarters and ordered staff to halt all supervisory activities, prompting resignations from top enforcement and supervisory officials at the agency. Later that month, the Trump administration reportedly denied claims it planned to dismantle the Bureau. So some payouts have affected. Case updates. So the CFPB has dropped its legal cases against specialty lender Heights Finance Holding Company and TransUnion, as well as its cases against Capital One Financial Corp, subsidiary Vanderbilt Mortgage and Financing, Inc., Rocket Homes Real Estate LLC, the Pennsylvania Higher Education Assistance Agency, and online lending platform Solo Funds. So interesting. So a lot happening there with the CFPB. I do have a little bit more news on them that I'll get to in just a minute. Some big news coming out of the FDIC this week. So the FDIC is set to rescind 2024 bank merger policy statement. So the Federal Deposit Insurance Corp is proposing to rescind its statement of policy on bank merger transactions, which it published in 2024. The proposal, which had been approved by the FDIC board, aims to address concerns that the policy statement added uncertainty to the merger application process. The FDIC's policy statement was aimed at providing greater scrutiny of transactions involving non-banks, pro forma institutions with more than $100 billion in assets, or institutions with adverse Community Reinvestment Act ratings. The FDIC proposal will reinstate the merger policy statement effective before 2024 on an interim basis as the agency reevaluates its bank merger review process. Interested parties may submit written comments on the proposal until 30 days after publication in the Federal Register. So I think this is a great thing. I think this is a great thing for the industry. The Biden administration, under their regulators at the banking agencies, at the FDIC, the CFPB, the OCC, they had really gummed up the works for mergers in the banking industry, and it was becoming a very big issue. Merger timelines were dragging out from 18 months to 2 years to 2.5 years to 3 years to who knows when, and you can't operate in the business world, let alone the banking world, under those kind of conditions. If you're going to merge with somebody, that merger has to get completed within basically 12 to 18 months, because if it drags on, you can have all kinds of problems. You can have shifting stock prices. You can have different things that come up. The economy might change. Economic environment might change. There's just a ton of uncertainty, and you can't be stuck in the middle of these merger transactions forever. You have to be able to get them completed in a timely process. So I'm very happy with this, and hopefully things will begin to get back to normal. Also, FDIC withdraws broker deposit proposal and 3 others. So the FDIC board approved the withdrawal of 4 proposals, including one related to broker deposits. So the broker deposits proposal would have notably affected several aspects of the deposit landscape, the agency said in a news release. Under the proposal, more deposits would have been required to be classified as brokered. 2 of the 4 proposals approved to be withdrawn relate to corporate governance and the Change in Bank Control Act. The corporate governance proposal would have resulted in an overly prescriptive and process-oriented expectations for management and boards of FDIC-supervised institutions with $10 billion or more in total assets, the agency said. The CBCA-related proposal would have removed an exemption from the requirement to submit a notice to the FDIC when acquiring voting securities of a depository institution holding company for which the Federal Reserve reviews a CBCA notice, according to the news release. The last proposal approved for withdrawal is connected with incentive-based compensation arrangements. The proposal was approved by the FDIC board in May of 2024, but unlike the 3 aforementioned proposals, it was never published in the Federal Register. So again, I think this is a great move. getting rid of what's going on here on broker deposits. That's again, fantastic news for the industry. And how do I want to say this? I think the whole thing with broker deposits, this was an overreach on things that had happened last year with the failure of Synapse Financial Technologies, which was a kind of a third-party fintech company that was operating with a number of banks. They, lost a whole bunch of deposits for customers because of intermingled funds and other things going on there. And that, kind of prompted a knee-jerk reaction from the regulators, if you will, and basically led to this rule on broker deposits, which, definitely seemed like an overreach at the time. So again, very happy to see that this has been withdrawn and not going to be a concern now, and not going to basically mess with banks' deposits and ultimately their balance sheets. Okay, 144 OCC employees accept Trump's buyout offer. I probably should have talked about this when we were talking about the labor market stuff, but so the OCC has seen 140 employees accept Trump administration's deferred resignation buyout offer as part of ongoing job cuts, Bloomberg Law reported, citing an internal email from the OCC's executive committee. These employees will reportedly be put on administrative leave while remaining on the payroll until September. The OCC fired 76 probationary employees in February, with many of the terminations coming in its mid-size and community bank supervision unit. According to the report, the OCC has about 3,600 employees before the probationary firings and deferred resignations. The regulator has also instructed its staff to return to the office by March 31st, which may lead to further attrition. The OCC declined to comment on the news to the media outlet. The FDIC also saw 500 employees, or around 8% of its workforce, accept the Trump administration's buyout offer. The report noted that about 75,000 federal employees opted for deferred resignation buyouts ahead of a February deadline. So this points out exactly what we were talking about earlier with the labor market, where, you've got this, you've got the what do they call it? The deferred resignation buyout. But then you also have, basically the employees getting cut who are on probation, probationary employees. So basically, like I said, cutting the low-hanging fruit, so to speak. So the two things that you see going on right now are working out and going forward. So again, I think this is a good thing in the long run. So okay. So let's see, what do we got here next? All right, the CHIPS Act. Okay, I'll come back to this. I got some other news articles and stuff here I want to hit, but first, I always like to get in. I want to talk about the economic indicators that are coming out next week. I also want to review real quick the episodes that I put out this week and talk about a little bit other banking news and stuff. We'll get back to some other things here in just a few minutes. So, what are the economic indicators that we have coming out for this week? So on Monday, March 10th, we have consumer inflation expectations. On Tuesday, March 11th, we have the JOLTS job openings. We have the 3-year Treasury note auction. We have the API weekly crude oil stock. On Wednesday, March 12th, we have the core CPI, the 10-year Treasury note auction, federal budget balance. On Thursday, March 13th, we get continuing jobless claims, core PPI, initial jobless claims, PPI, 30-year Treasury bond auction, and then finally on Friday, March 14th, we get the Michigan consumer sentiment and the U.S. Baker Hughes total rate count. So a lot of inflationary numbers and some labor market numbers this week. So we're going to get the PPI and the CPI this week, give us more indication on where things were headed with inflation. So we'll definitely be looking forward to that, as well as some Treasury bond auctions. But we got the JOLTS, the initial jobless claims, and then obviously the consumer sentiment on Friday. So some good economic data coming out this week, and we'll see what happens. And I'm sure we'll be probably hearing some additional comments from the Federal Reserve and the Treasury based on how those inflation numbers look. So, okay. Let's talk about the episodes that I put out this week. So I had, in my standard format, I had 5 episodes came out this week, Monday through Friday. Episodes get released at noon each day. You can find them on YouTube or Rumble or any of the major podcast platforms. Just my little plug right there. So, okay. So on Monday, I had episode 332. Does the CFPB have a future? With everything that was going on with the CFPB right now, I really just wanted to cover this. So this episode examines a recent article from Bank Director titled Chaos Consumes the CFPB, Causing Uncertainty, and recent reporting from CNBC as well. So the CFPB was effectively shut down a few weeks ago when acting director Russell Vought took over. All legal cases and regulatory rules were halted upon further review. The CFPB has 1,700 employees, but is only required to have a few hundred by law. Will the CFPB be shut down completely, or reduced to a very small regulator, or just get streamlined to be more efficient? So check out that episode if you want a little bit more in depth with that. Obviously, we will continue to cover and talk about the CFPB as we go forward with that. Episode 333 are super billionaires driving the economy. So this episode examined two recent articles from the Wall Street Journal titled "The U.S. Economy Depends More Than Ever on Rich People," and Meet the World's 24 Super Billionaires. So as the wealth gap continues to increase, consumption in the American economy continues to rely more and more on the spending of the ultra rich. And the question is that sustainable? So really interesting articles there looking at this new class of billionaires, and the super billionaires, if you will, was defined as billionaires that had to have at least 50 billion in net worth or greater, and that's what basically defined this new class of super billionaires. And obviously, the 24 people on the list were well-known people. I mean, Bill Gates, Warren Buffett, Larry Ellison, a lot of the, Elon, obviously, Jeff Bezos, Mark Zuckerberg, a lot of the usual suspects on that list. But what was really interesting, though, in that was with the first article, basically saying how a huge chunk, like over a third of spending, is now dependent on the top 20%. And probably even more particular, the top 10% of income earners, which was really interesting. Okay. On Wednesday, I put out episode 333, which was a review of the FDIC quarterly banking profile for the fourth quarter of 2024. So that episode examined the FDIC's quarterly banking profile. How did banks perform overall for the fourth quarter of 2024? How did community banks perform in the fourth quarter of 2024? And how is the Deposit Insurance Fund, or known as the DIF, how is that performing? So this is a quarterly report that's put out by the FDIC. It's a great report. I always cover this report. Like every time this comes out, I do an episode covering this. So if you wanted to, if you really needed to, you could go back and look at the coverage of all four quarters from last year just to get an idea. I think it's good because you kind of see like a rhythm, if you will, in the numbers as you look at more of these reports. And that's why I like to go over them. And the reports have three main parts. It gives you the overview of the industry as a whole. Then it goes down and says, okay, let's take a look at community banks, basically being on any bank under 10 billion in asset size. They look at community bank performance, and then they look at the Deposit Insurance Fund. Like, how's the Deposit Insurance Fund performing? Are things going okay? That kind of thing. So, but it's a great report to look at. Episode on Thursday, I did episode 335, how to combat the rising cost of small business lending. And this episode basically examined a recent blog from the PCBB, which was titled "The Rising Cost of Small Business Borrowing, How CFIs Can Help." So lending right now for small businesses is difficult. High interest rates, inflation, and tighter regulation are making it tough to borrow money. What can banks do to combat these issues and continue providing the capital and help that small business owners need? So I think this was a good episode. It looked at a lot of the different challenges that small business owners are currently facing and provided a few thoughts on what can banks do to basically help the small business owners right now get the lending that they need. And then finally, so on Friday, yesterday, I did episode 336, which was called the CFO Roundtable Discussion. I tried something new with this episode. So this episode examined an article from the Independent Bankers magazine titled CFO Roundtable 2024, Preparation, Diligence, and Perspective. So this CFO Roundtable took place in August of 2024 and asked the panelists 6 questions around various topics, which included CECL, interest rate risk, shifting role of the CFO, credit risk, bank earnings, and technology. So I thought the article was great because it provided strong insight into how bank CFOs feel about the current environment. And I also pointed out in that episode that how cool I thought the CFO job was. I really think the CFOs have one of the coolest jobs in the bank. They have their hands in everything. They're critical in terms of managing the balance sheet for the bank. They have a lot of input into how the bank, just how the bank invests its money into its assets, whether it be investments or lending. A lot of times the CFOs are involved in loan committee or definitely higher loan decisions for, say, loans that go to the board and things like that. But more importantly, the CFOs manage all the budgets for the departments in the bank. Any kind of special project that comes into the bank, it's got anybody like, hey, we want to buy this new computer system over here. Got to go to the CFO. You got to go to the CFO. You got to get them to sign off or approve the project that you're working on or want to work on. So I really think that the CFO job is really cool. But I thought that covering this roundtable was really nice because it gave you a perspective into what the CFOs in the community banking space are feeling right now. And it was 6 CFOs from all different parts of the country, different size banks. So again, I think you've really got a really good discussion of what was going on in banking right now. And I'm going to try this again. I have a similar article that I found that was basically from January. That was basically this. Now this was from the CEO perspective. So this was the CEO outlook amongst community banks in the U.S. Where a number of community bank CFOs chimed in on what they thought about the current economic environment. So I'm probably going to cover that this week. And just see how people, again, I love everybody's feedback. If you watch that episode or you're watching this and you think you like that kind of stuff, or, I could use the feedback is what I'm saying. Give me feedback. Let me know if you like it, you don't like it, whatever. So, again, feedback is good. Feedback is key. So, okay. All right. So let's get back to, do I have any other news here? We talked about that. Let's see here. ICBA commends the FDIC for rescinding the proposals that they rescinded, which we went over, which we talked about. Senate committee votes to advance the FHFA and CFPB nominees. So the Senate Banking Committee voted to advance the ICBA-backed nominations of William Pulte to be director of the Federal Housing Finance Agency and Jonathan McKiernan to be director of the Consumer Financial Protection Bureau. They will head to a full Senate vote for confirmation in the coming weeks. So that's good. Good news there. ICBA applauds Secretary Bessent for supporting community bank and prudential agency independence. Speaking in New York, Bessent said the Trump administration's work to streamline banking regulations and ensure agency coordination would not include consolidations of the nation's prudential banking regulators. To be clear, this does not mean consolidation of agencies, but coordination via Treasury such that our regulators work in parallel with each other and the industry. So, okay. So in other words, some people in the industry are worried about consolidation of a bunch of the regulators. Doesn't sound like that's the direction that Treasury Secretary Bessent wants to go in, but we'll see. We'll see what happens with that. Okay, ICBA participates in a cross-border payment discussion. So the ICBA's Brian Laverdure participated in a private-public sector discussion hosted by the Financial Stability Board in Basel, Switzerland, focused on recommendations for regulating and supervising bank and non-bank payment service providers offering cross-border payment services. So, anything over there in Switzerland is, you gotta just kind of shake your head. I would run personally if they ever called me and say, "Hey, you want to come over to Switzerland? We want to talk about some things that we want you to do." I'm like, I'm good. I'm okay. Resolution to nullify the CFPB overdraft rule passes the House committee. So the House Financial Services Committee voted 30-19 to pass HS Resolution 59, Congressional Review Act resolution that would overturn Consumer Financial Protection Bureau rule that regulates overdraft fees. So good news there. We'll see what happens with that. ICBA backs bill to raise CTR and that stands for Currency Transaction Report. So CTR and SAR reporting thresholds. So introduced by Rep. Barry Loudermilk, Republican for Georgia, the Financial Reporting Threshold Modernization Act, HR 1799, would raise the CTR and SAR thresholds to 30,000 and 10,000 respectively, and index the CTR threshold for inflation every 5 years. Again, I think that would be a good thing. I mean, the amount of CTR and SAR reporting, I think that really needs to be perhaps even looked at more in depth, because the amount of the volume of CTR and SAR reporting has gone through the roof in the last number of years. And while the banking industry certainly deals with a lot of fraud and a lot of different types of fraud, I think it could be done better. I think it could be done in a better way. That, because again, some of this stuff is just, again, a SAR is a suspicious activity report. It does not mean that any crime has been committed. It doesn't mean anything's wrong. It just means that maybe something that appeared suspicious happened. So a lot of times, unfortunately, your compliance people, they get kind of run around in circles, if you will, investigating and looking into a lot of stuff that basically leads them to nowhere. And so I think there's got to be a way that could be done better and in a more efficient manner. And kind of the same thing with the CTR. People come in and do stuff, and it's again, this stuff is not, people aren't necessarily doing bad stuff, but you come in, you do a couple transactions over $10,000, and all of a sudden, oh, we got to report that, we got to look at it, we got to do everything. So again, I think that's a good step heading in the right direction, but I definitely think that there's more that could be done there. So ICBA advocated ACRE Act introduced. So the bipartisan bill introduced by Senators Jerry Moran and Angus King in the Senate and Reps Randy Feenstrada and Don Davis in the House would exempt from taxation interest income on farm, real estate, and rural mortgage loans in small towns, allowing community banks to lower loan rates and lower cost of credit for these borrowers. So thus the ACRES Act. So it's farm related. So hopefully that will get through to help out some of the farmers. USDA's Rollins says $31 billion in farm aid is coming soon. So Agricultural Secretary Brooke Rollins said the USDA expects to meet the congressional deadline on March 21st to send out the $31 billion in farm aid that Congress passed in December, according to reports. So again, ICBA backs bill to enhance regulatory flexibility. So the ICBA recently expressed support for legislation to support more flexible agency rules that take account of the size and compliance resources of small businesses. So this was introduced by Rep. Scott Fitzgerald. The Making the CFPB Accountable to Small Business Act would require federal regulators to, 1, describe how requirements for small businesses minimize any additional cost of credit before analyzing any rule, and 2, provide a detailed justification if they determine that no alternatives to the final rule exist. So I think that will be pretty good. And then finally here on this piece, the ICBA opposes GM's ILC application. So ICBA said General Motors Finance Bank's application for FDIC insurance threatens the deposit insurance fund and doesn't serve the convenience and needs of the community. I agree. I don't like what's called the ILC loophole. I think that needs to be gotten rid of. And again, this is another topic in banking that has been discussed for years now ad nauseum. And it's not a good thing. I think that if you want a bank charter, you should just apply for a bank charter. And if you get the bank charter, then you just have to comply with what everybody else. It's just a level playing field. You just have to, you have to comply with what everybody else has to comply with. No more, no less. That's all. But anyway, okay, let's get back to this. Sorry, guys, I got to take a drink here for a second. All right. Let's get back to a few more articles here before I wrap this package for the night. So, okay, I thought this was an interesting article here. I just wanted to point this out. So Republicans who opposed the CHIPS Act are skeptical of Trump's talk of eliminating it. And the truth is told, I doubt Congress will repeal the CHIPS. A CHIPS and Science Act opponent, Senator Josh Hawley, told the Epoch Times. So, they kind of discuss here in this article, should they repeal the CHIPS Act, not repeal it, whatever. The problem with the CHIPS Act, and I don't really have another way of saying this, is that the CHIPS Act is I think a good piece of legislation. It tries to bring chips manufacturing back to the U.S. The problem lies on the execution, and some of the as they say, the devil is in the details. There was an unholy amount of woke stuff in the CHIPS Act. Okay, that's the best way I can describe it. I have a friend who works for a company down in North Carolina. And they were very interested in trying to get some funds from the CHIPS Act. But when they took a look at it, the strings, if you will, that were attached for it, basically the quotas they had to meet, people they had to hire, there was a ton of strings that went along with it. That basically they got to the point after reviewing it where they basically said, "Hey, I'm out. I don't want to deal with any of this nonsense." And I think therein lies a big part of the problem. Even Taiwan Semiconductor, which is building this massive plant in Arizona, Trump announced that they were gonna now put in $100 billion. My guess is because they were complaining about it. They basically said they took the CHIPS Act money and we're gonna do all this development. Design a state-of-the-art, what they call the fab in the semiconductor industry. They were going to build a state-of-the-art fab down there in Arizona. And but then they started complaining, basically saying like, "Hey, look, man, this is highly technical work, and we need really good, experienced people to be doing this stuff. We can't just put any old person out there." But you're basically forcing us to hire people that really aren't qualified to do what we need them to do. So they were really grumbling about this and complaining about it. And my guess is that they went back to Trump, and Trump basically said, "Yeah, forget all that. We're gonna get rid of all that. We're gonna cut it all out. And you guys come in here and just do your thing. You guys come in here and build this. Hire who you want to hire. Get the people you need. As long as their U.S. jobs are being created, I'm happy. And just do your thing." So that brings me to the key point here of this article, and that is, do we need to repeal the CHIPS Act? No, I don't think so. I don't think we need to repeal the CHIPS Act. I just think it needs to be amended. I think if you go in with an amendment and you say, all right, we're going to take all the woke garbage out of there and we're going to make this more streamlined and actually get the money out there to these companies so that they can go forward with this stuff. I think that's, and not just play again political games and say, "Oh, if you're in New York, we'll give you money, but if you're in a state that we don't like, then we're not going to give you the money." Like that kind of stuff. If we could get rid of that garbage and just get the money out there and just increase manufacturing and increase jobs and use the bill the right way, then I think it could be a home run. So, but like I said, we'll see what happens. I happen to agree with Josh Hawley's comments here. Do I think that they will repeal the CHIPS Act? No. And part of that is not necessarily the act itself. It's just the nature of politics. It is, unfortunately, when any bill gets passed, it can be very difficult to repeal it. And especially at a time when, I hate to say it, but the truth is there are far more pressing matters on the table at the moment. This is one of those things that's going to fall to kind of the back of the agenda for the moment. So again, I don't really have any, hope that anything will get repealed there. But again, I don't think you need to repeal it. I just think you need to amend it and get it out there the right way. So I don't know, that's just my take on it. So, okay. Other big news this week. So Trump launches a U.S. strategic Bitcoin reserve, a digital asset stockpile, if you will. So U.S. President Donald Trump signed an executive order establishing a U.S. strategic Bitcoin reserve as well as a digital asset stockpile for other cryptocurrencies, but put potential limits on buying more of the tokens beyond what is held by the federal government. The reserves will be capitalized with Bitcoin already owned by the U.S. government, and any new purchases would require budget-neutral strategies, the order said. Bitcoin, which had reached a high of around 109,000 in January, was down less than 1% to trade around 89,000 on Friday. So Trump had promoted the idea of creating such a reserve on the campaign trail and sparked a crypto rally earlier in the week by suggesting 4 more tokens could be included in the reserve beyond Bitcoin. The Secretary of the Treasury and the Secretary of Commerce shall develop strategies for acquiring additional government BTC, provided that such strategies are budget neutral and do not impose incremental costs on United States taxpayers, the executive order said. The order also said that the U.S. wouldn't acquire more stockpile assets beyond those forfeited in criminal or civil proceedings without further executive or legislative action. The news initially sent cryptocurrencies lower, but by early Friday, the price of Bitcoin and the 4 other tokens that Trump had said could go into the reserve were paring their losses. Bitcoin, which had reached a high of around 109,000 in January, was down more than 1% to trade around 89,000. Ether, Solana's Sol token and Cardano's ADA were all little change, down around 3%. Investors are awaiting more news from the crypto summit Trump is hosting with cryptocurrency executives at the White House on Friday, which he did. But again, so it's kind of interesting. So the government already owns basically $5 billion in crypto. I guess it's an interesting thing because I do think it's a good idea. I do think it's a nice little side project, if you will. Is this really? And I think this is what was probably initially a little disappointing. I think the crypto markets were expecting him to say, "Oh yeah, we're going to set up this strategic Bitcoin reserve, and wait for it, we're going to go out and buy a ton of Bitcoin, which is going to It's going to pump the price of Bitcoin way up." And that's not what happened. Trump basically said, "All right, look, we're going to start this reserve. We're going to take the $5 billion we already have. We're going to dump it in there." And then we might invest in some other, digital tokens or whatever. But we're not just gonna turn on the spigot and start spending a ton of money in the crypto space. And I think that was disappointing to a lot of the crypto bros and the crypto people, if you will, that are involved in this. So I will have more on this. I'm working on. For people that haven't watched or don't know, I do a crypto series. I've done 16 episodes of the crypto series, and I try to cover all aspects of crypto in that crypto series. I've done the history of crypto, the crypto winter, the crash, if you will, of 2022, how I think crypto connected directly to the banking crisis that happened in 23, all kinds of different fraud cases, different things that have happened in the crypto world. I've covered a ton of stuff, and I'm working on an episode right now where I'm going to talk about this whole Bitcoin reserve, the meeting at the White House here that happened yesterday, the crypto summit, if you will, and then also just talking about some of the other things that are happening right now in the moment in the crypto world. So stay tuned for that. That'll be coming up. Okay. CFPB drops lawsuit against JP Morgan Chase, Bank of America, and Wells Fargo over Zelle fraud. So if you use Zelle, the payment app, you might want to listen to this. So the CFPB on Tuesday dismissed its lawsuit against the operator of Zelle Payments Network and the 3 U.S. banks that dominated transactions on it. The CFPB sued Early Warning Services, which runs the peer-to-peer payment network, as well as JP Morgan Chase, Bank of America, and Wells Fargo in December, alleging that the firms failed to properly investigate fraud complaints or give victims reimbursement. The CFPB dismissed this action against defendants Early Warning Services, Bank of America, JP Morgan Chase, and Wells Fargo with prejudice, meaning that they cannot bring the suit again, the regulator said. So the CFPB, again, they sued Early Warning Systems, basically saying that they weren't protecting customers against fraud, because they had received a lot of fraud complaints, or they had not given fraud victims reimbursements. So couple of thoughts on this one real quick. So yes, I think that I don't know that this lawsuit should have been dismissed out of hand and rightly so dismissed with prejudice. If I had to think about this in other terms, you might say that maybe the government is looking for other things out of those big banks, and maybe they got rid of this because they're looking to do something else. Maybe I don't know. I don't have any information. I'm just speculating, if you were, on why this might have happened. But again, so JP Morgan, Bank of America, Wells Fargo, the other big banks involved in this, I will say this, they probably weren't being as responsive as they should have with claims that were being made for customers and with returning some deposited funds. I will also say that if you use these basically like instant payment apps, like if you're using Venmo or Cash App or Zelle, their terms and conditions clearly state that, hey, look, this money is going to go out and it goes out instantaneously. When it goes out, if you send it to the wrong place or the wrong person, it might be very difficult, if not impossible, to get your money back. So, so that stuff is clearly stated. So you need to be aware of that stuff when you're using these payment platforms. It's part of the reason why I don't really use them and haven't used them. I mean, do they make it convenient in certain respects? Yes, they do. But I guess being who I am, doing what I do, and seeing all the fraud that I see, I'm apprehensive to use this kind of stuff. So, but anyway, just an interesting story. I thought I would report on and put it out there. Here's another interesting one. So Walgreens to go private in a roughly $10 billion deal with Sycamore Partners. So Walgreens said it inked a deal with private equity firm Sycamore Partners that would take it off the public market for an equity value of around $10 billion. So the historic transaction ends Walgreens' tumultuous run as a public company, which began in 1927. Walgreens has been squeezed by the transition out of the COVID pandemic, pharmacy reimbursement headwinds, softer consumer spending, and a troubled push into healthcare. Yes. So, Walgreens, which was amazing. I'm trying to look for it here. Walgreens was worth what, 300 and something billion dollars, and they just got taken private for 10 billion. I mean, that's wild. And it just goes to show you the problems that Walgreens and again, I reported on this. I did a whole episode where I talked about the problems with Obamacare and the problems it's created for the healthcare industry and how we have hospitals that are failing, and ultimately how, the pharmacy industry, they killed all the mom and pop pharmacies and they pushed it all back into Rite Aid, Walgreens, and what's the other one? CVS. And how all three of those companies now, Rite Aid filed for bankruptcy, Walgreens and CVS cutting stores like crazy. All three of those companies had major problems. So again, just kind of a sad end in a way to Walgreens, and I'm sure they will be cutting more stores and divesting themselves of different business lines and all that stuff. I'm sure all that stuff will be coming down the pike. And then I think this is the last article I'm going to go into here tonight. So the FDIC okays Rhode Island Bank's wind down plan. This is reported by Bank Drive here. So Independence Bank was ordered to pay a $3.5 million in restitution after the lender allegedly charged illegal fees for Small Business Administration's 7A loans, causing the agency to lose $8.8 million. So the FDIC Corp has approved East Greenwich, Rhode Island-based Independence Bank's plan to liquidate, so basically self-liquidate, according to FDIC enforcement actions released Friday, settling a years-long back and forth between the lender and the regulator. The bank was required to pay restitution of $3.5 million to affected consumers, according to a January 14th order. The FDIC accused the bank of charging illegal fees for Small Business Administration 7A loans and causing the agency to lose an estimated $8.8 million. Since the bank seeks to terminate deposit insurance and surrender its banking charter, Independence was ordered to dispose of any SBA loans still in its portfolio and ensure continuance of servicing rights and obligations connected with any of its SBA loans, according to the consent order. The community lender, which neither admitted or denied the FDIC's allegations, also must ensure it's compliant with all laws and regulations related to ongoing maintenance and required information technology infrastructure, as well as document and data retention, the FDIC said. The development wraps up a saga that stems from an SBA lending scheme the FDIC said was perpetrated between 2017 and 2019 by the bank's former CEO, Robert Cantanzaro, former Chief Operating Officer Danielle Desrosiers, and John Ponte. a loan referral agent who referred small businesses to the bank for SBA loans. According to a February 2023 FDIC complaint, Cantanzaro caused the bank to enter into a high-risk, non-diversified SBA lending strategy. Ponte's company targeted struggling small businesses and referred the vast majority of SBA loans the bank funded. On average, about 76% of the dollar amount of SBA loans approved and funded by independents was from loans referred by Ponte, the FDIC said. Additionally, Ponte's company offered high-interest bridge loans to SBA loan applicants while they awaited approval and funding from the bank, the FDIC said. Interest rates on these loans were 50% to 100%, the FDIC said. Interesting. Ponte sought to shift the risk associated with these bridge loans, arranging to have the loans repaid from the proceeds of the SBA loans made by independents and concealing information about the bridge loans and their repayment from SBA loan proceeds, the FDIC charged. The SBA found the default rate of loans issued through the independents to be 5 times higher than those of peer banks, which cost the government agency millions of dollars. Let's see here. All three faced FDIC fines. The bank sued the FDIC and Rhode Island Department of Banking Regulations in federal court in Rhode Island, October 23, accusing the regulators of blatant federal and regulatory agency overreach. All right. So again, this is very interesting because this actually happened to a bank here in the local PA market. I'm not going to mention any names or anything at the moment, but a very similar thing happened, and the bank was in a lot of serious trouble. They didn't get charged by the FDIC or anything like that, but everybody kind of recognized what had happened, which is very similar to this incident. And ultimately, the bank got got absorbed by another bank. The situation kind of went away. But it left a few of the executives and people that were involved in it. It kind of left them tarred and feathered, so to speak. So it was a very interesting scenario. So, but for them to self-liquidate like this, I mean, this must have been pretty bad. This must have been pretty bad, and this must have been in. It sounds bad. It sounds very bad, but we don't necessarily have all the numbers to look at. I mean, yeah, it was they were ordered to pay $3.5 million. We don't really have numbers on necessarily like how big the bank was, like what their asset size, the kind of money or income that they made, that kind of thing. But it must have been in danger of basically sinking the bank, and whatever was going on there. Because again, in a situation like this, you're always finding buyers, right? So they obviously couldn't find any buyers. So that's a big issue there. So again, another interesting story. Just thought I would bring you guys. So, all right, so let's wrap up here. I'm going to go to. So I got my little story of the week here, and then I'm going to go to my quote of the week here to wrap us up here. So last week, I talked about the first banking crisis in the United States, which was the banking crisis of 1792. So now I'm going to talk about the first bank failure in U.S. history. So the first U.S. bank failure was in March of 1809. The first U.S. bank failure occurred when the Farmers Exchange Bank in Gloucester, Rhode Island went under. The bank had been purchased the year before by Andrew Dexter Jr., a lawyer, financier, and speculator who wanted to build an enormous exchange building that would be the financial nerve center of Boston. To pay for the construction, he acquired several banks and issued hundreds of thousands of dollars in banknotes. When some merchants became suspicious, it was discovered the notes couldn't be exchanged for gold or silver, and Dexter's fraud was exposed. That led to the collapse of Farmers Exchange Bank, which has issued $760,000 in notes, but only had $86 in gold and silver on hand. Pretty wild. I actually have a whole book detailed that whole thing. It was a pretty interesting story to read about, and I will someday, somewhere down the line, I will do an episode probably reviewing that book and covering that whole story, because I think it is a very interesting story, and it's notable because it was the very first bank failure in U.S. history. So, okay, now our quote of the evening. If you can't trust a Swiss banker, what has the world come to? And that was famously quoted by James Bond in The World Is Not Enough. I think very apropos. If you can't trust a Swiss banker, then what's the world coming to, right? All right, everybody. Well, I thank you so much for joining me tonight. I'll just, wrap up by saying if you like this, please make sure to like, share, and subscribe as it really helps the channel. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to leave your comments down below as it always helps. And I love getting back to everybody. Make sure to check out all the episodes that I put out during the week. Like I said, episode every Monday through Friday at 12 o'clock. Check it out. Either, like I said, Rumble, YouTube, any of the major podcast platforms. But I hope everyone has an awesome weekend, and I will see everyone again next week. Be safe out there and take care.